Hi everyone, I hope you're all doing wonderful today. I'm the Portfolio Panda. Nearly every day there's a headline in the news about rising inflation and the continuing unaffordability of life in the modern day. While the thought of people losing their homes and personal insolvency isn't a particularly pleasant topic, I have to switch off that side of myself and consider what companies might have the opportunity to prosper in such an environment. I'm going to have a look today at Corp Group Limited. Credit Corp operates in the distressed consumer debt market. In its core business, it acquires purchased debt ledgers, or PDLs, in Australia and is expanding this business globally by buying PDLs in the United States. These PDLs consist of unsecured debt that are at least 6 months in arrears and have already been through a collection process. How do they make a profit? Debts are mainly acquired from banks and financial institutions and are mostly unsecured credit card debt. Other forms of debt purchases include outstanding telephone or utility bills. Earnings are generated by recovering more than they paid for the debt. The firm targets returns on equity of 16 to 18% and aims to recover double the price paid for PDLs. They tend to pay 5 to 20 cents on the dollar for the debt's face value. Credit Corp does this by acquiring PDLs at low prices and collecting mainly via payment plans. Knowing this, if I'm ever in a situation where they are chasing me for repayments, I'll be lowballing them for sure. They also provide consumer-facing products including impaired consumer loans, auto lending, buy now pay later, and appliance leasing. It generally lends to credit-impaired consumers who do not have access to primary lenders. This provides a source of revenue for economically prosperous times as well as their main business in the down times. The debt collection industry's low barriers to entry mean Credit Corp cannot ensure stability in the long term. In its PDL businesses, the firm mainly purchases from the major banks and financial services companies, which sell bad debts as part of their capital management and loss provisioning process. These institutions have stronger bargaining power than Credit Corp as they are larger and ultimately can decide who to sell to and how much to sell. Debt collectors like Credit Corp cannot often deliver high economic returns with strong and regular profit margins. In general, a debt collector either buys into PDLs for very cheap but faces lower cash collections during economic downturns, or pays more for PDLs but benefits from better cash collections during economic upturns. If we are to expect a future downturn, it should result in higher defaults and increase the supply of PDLs, lowering PDL prices, which would allow Credit Corp to accumulate bad debts, but there is much uncertainty surrounding the collection of such debt. Credit Corp is also exposed to ESG-related risks such as potential reputational damages due to predatory lending, or compliance and regulatory breaches. Such events could result in loss of funding, loan referrals, and PDL sales from primary lenders like the major banks. There's a lot more uncertainty surrounding this business than I was expecting before researching this topic. Hopefully this can provide you with a bit of insight into the company and their operations. As usual, let me know any questions in the comments below and make sure to share this with your least financially savvy friend and tell me if I did okay in explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.